Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 3:30 in New York on Thursday, the 20th day of March 2014, and this is the daily report for gold and silver. Following Fed statements by our new chairperson, Yellen, yesterday, it seems as though we have the equities markets kind of turning on their interpretation of what was said. We have sharply higher pricing in the equities markets. Dow Jones up about 100 points. Gold, however, is tracking lower along with silver, platinum. Palladium is the only precious metal out of the group that is trading higher to gold. As you can see, we're currently looking at $1326.80. Puts it off a little bit over $3 on the day. The low $1319.90, the high $1336.20, and that would have been on a 24-hour period yesterday, of course. Silver also tracking lower on the day. It's actually off 1.7% as opposed to gold, which is only off 0.2%. Low 20.06. We can see that right in here. The high is 20.81. Current print 20.25, and as I said, puts it off roughly 35 cents on the day. More on silver towards the end of the show. I want to start today's show by talking about some of the parameters that we are going to be looking at for our next trade trigger to re-enter the market, re-enter on the long side. We're under the assumption right now that whether we're in a counter trend or in a full-blown impulse phase or a bullish rally, there's no question that we've seen a significant rise when we consider that at the beginning of the year, 12/31 here, but at the beginning of the year, we were at around 1180. That seemed to kind of turn around because we had this tremendous rally, and this tremendous rally took us over 100 and then up to $200 higher. Now, from there, we would expect some sort of a retracement, and as I said in my market forecast yesterday, to me it wasn't a question of if we would see this market retrace, but when and where, price-wise, we would see the market retrace. It's a normal and healthy function on a market which is trading higher to have these rounds of profit taking. I kind of look at it as releasing steam in a pressure cooker. Without it, you can have all kinds of crazy things go on. So we look for those corrections in the market. Now, currently trading 1327.85. And what I'm looking at, first of all, is whether or not it's going to hold this particular area. Because if you recall, 1329 on our way up was our original target for our top. And as the market came up, you can see this was the first point it hit. It did correct just a little bit, but then exceeded it. Went higher, about 1345, then comes down and finds this level of support here. Trades up again. We get, if you recall, we talked about this. We had this series of double tops that we needed to take out. We, in fact, did it. And the market really ran from about 1330 all the way up to 1390. So a $60 spurt on this all green area. Now, so the first thing I want to look at is, are we going to be able to hold this particular area? Now, let's look at a couple of different potential models. Let's assume that the market does hold in this area. Let's go ahead and blow this chart up. If it did in fact hold in this area, then we want to be cognizant of the following. Again, 240-minute chart, solid red all the way down. We have our first doji candle in here. And so what we would really want to see is, I've put a very, very rough, but nonetheless a resistance line, and it's just looking at these series of tops. And we would need to really see the market break above that resistance line to cross over that threshold, of course, before we would take a stab in the market. But I think it's a little bit early to make that claim, because when we look at our fib retracement levels, you can see that we could have lower action, and I think that what I'm looking at in terms of lower action could be as low as about 1314. That's what I'm looking at. And one of the best ways really to look at this most recent move, I pulled up a daily chart. And on this daily chart, I have basically added two different fib retracement levels. One which starts beginning of this rally and takes us all the way up to the top, or the full $200 move, going from 1180 and change, call it, to 1390. The second retracement level that I'm putting in starts from about 1236 and moves up. And the reason that I'm putting in 2 is you can see we had this dynamic rally, but then the market really genuinely traded sideways, so that it makes a case for these 2 bottoms to be kind of important. When we do that, we get different fib retracement levels. Of course, the longer of the 2 are these marks on the left. On the right, you can see the shorter of these 2 retracements from this retracement right in here. Now, when we do that, of course, 23% is 1343, and a 38% of the shorter retracement level is 1332. We're just below that. But if you come down to this area, and we touched upon it very, very briefly, I look for one of the important things that I look for, let me preface it by saying that, is what I tend to call Fibonacci harmonics. And it's my definition of harmonics. And what I'm looking at is when we have 2 different time cycles with different price points that we start at, like this, we look for points in which we get a similar outcome but a different level. So we have a 38% retracement level at 1330, 1313, and a 50% at 1314. So when we put the 2 of them together, what we get is a band that I believe gives it a little bit more strength, because you have a common number right there. So what am I looking at? Well, I would not be surprised to see the market track a little bit lower and on an intraday basis, because traders, very few people are going to see it rest there. If it does rest there, it's probably going below there. But on an intraday basis, like we got this low here, which is roughly at around 1320, we should see maybe one more touch of these lows and then a move up to conclude this correction of this most recent rally. Now, when I go ahead and compress the chart so we can really take a decent look at some of the areas we'd be looking at, of course, this was 1365, and we definitely exceeded this top here. So my sense is that once we've had this beautiful rally in play, we had some good trades there, we see the market come down and touch this one particular area, 1314, I would then look for the next wave impulse to actually come in and challenge this particular high, which is sitting roughly at 1435. It is important that it comes and challenges this, because this is giving us more technical confirmation, in fact, that we are in a full-blown bullish rally, an impulse phase, as opposed to a counter trend to this long-standing bear market that really was predominant through 2013 and 2012, a little bit, and, well, call it October of 2012. On top of that, of course, we have one other top, and that top comes in just below 1500 right in here. So the question to me is, are we in a counter trend, or are we now in a full-blown impulse phase? And my definition and the evidence that I need to really see to be able to say that we are fully immersed in an impulse phase as opposed to a counter trend comes back to these markets moving back towards these highs. And if in fact they do that, they're going to have an effect on our channel chart. Let's go ahead and pull that up. And of course, this is the daily chart that I'm talking about. And there's no doubt at all, we saw this market actually breach and break above this channel line. It was the first time we witnessed that since putting in this Andrews pitchfork here. And it's quite easy to see how it broke above it, but it's also very easy to see that it just broke right above it and is now tracking back in it. So where might it go? Well, according to this channel line, we would look for it to really touch upon this particular channel right in here, which is the 23%. However, without really blowing this chart up and moving it over appropriately, will we get an idea of what that particular number is. So let's go ahead and we'll look to see where that channel line comes in. And if it were to go that low, we would have to actually cross below 1300. So I'm not looking for it to actually go back to this channel line. My personal sense is that would be much too deep of a correction. However, one fact clearly remains: even though we are back into this channel for the first time, we broke through it. Talked about a pattern called a scouting party. It's a pattern identified by Steve Nissan. It's not a candlestick pattern, but rather a pattern in which on an upside rally as it goes to new highs, I'm not saying record highs, but new highs, a 6-month high, a 4-month high, it is in essence testing the fortitude of the bears. And the fortitude of the bears at this price point was strong, because there's no doubt as it came back up here, it did track lower, and track lower quite hard and quick. Now, although there's no doubt gold has been under significant pressure yesterday as well as today, the pressure is nothing like what we're experiencing in silver. We saw silver move, as I said, down roughly 1.7%. It's a tremendous drop in the marketplace in terms of percentage losses. We can clearly see that $20 right now, this is 2009, is providing a level of support, at least short term. Our resistance is obviously going to be 2047 to 2058. It really would have to go and take out these former tops right here. And that is currently where I am pegging resistance in silver. We are sidelined in the market. We are waiting for a trigger before we enter. And the parameters that we talked about are exactly what we want to watch, and watch closely. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly review and wrap up. Bye-bye.